Hello everyone, Maple Stacks here. In today's video, I will be going over how to enter trades and knowing when to scale out, as well as identifying how to move your stop loss up along the trade as it is moving in your favorite direction. So for today's example, I will be going over QQQ's chart on August 24th, and we will be going over my perspective on how to trade the open. Now on the open, I normally have two contracts opened up on my active trader, also identifying within a range from pre-market. You can see in this range here on the 5-minute chart in the bottom right, this is your pre-market low and your pre-market high. So normally off of the open, I like to look for potential dip areas or areas of resistance where sellers may meet price action in order to defend or cut their position. So off of the open, I would normally watch if it was going to push down 1 to 3 out of the money strikes on QQQ. So listed here, I have the 315 calls as well as the 313 puts, just watching both perspectives. Off of the open, I immediately mark the open low of the candle. Normally I do this on the 1-minute chart. You can do it off of the 5 or the 10, but normally I'm doing this off of the 1. And on this 1-minute chart, it will normally show an area where buyers and sellers can base risk off of. Now, we know off of the first 30 minutes, typically we see a very tight consolidation range most of the time, but not always. So this open low will really help you identify where buyers and sellers may try to maintain price. So we can see on the 315 calls, it opens up, which is this low of the 1-minute candle, at $2.90. Same thing on the 313 puts. You can see that they open up $2.96. Now, what I like to see is how a buyer on either the calls or the puts contracts will be able to defend this support area. And I'm looking for an entry close to this open low if it does maintain, or any support pivot that maintains after the open, with a stop loss around 10 to 15% on the option. So we can see here from the open low, it does dip down to 274 on this pullback here, which pulls right back to the pre-market low, as well as multiple dips. And you can see this after the fact, and you might say, hey, how can I align myself with these low risk positions that end up paying very well, as we can see? So what I like to do is mark this open low. You can go off of the 5-minute or 10-minute chart, but try to find an entry within this opening range of a very small, tight demand zone or supply zone if you're looking on the underlying for puts, and see where you would have the least risk to have exposure in the market. So we can see within this range between $2.74 and $2.90, had a buyer placed an order around $2.84 to $2.90, even right at the open price, your risk would be about 29 cents for 10%. So if I mark this down and I bring it down and it says negative 10% right here, this would be a buyer stop loss for 10% from the open low at $2.90. As well as the flip side here on the puts. You can look at the open low, said, hey, if they were going to maintain this consolidation range, which we see off of the 1-minute chart, the puts could have prevailed, but ultimately one side faulted, and which would ensue sellers turning into buyers, adding to that pressure, which can form a trend. Looking at this 10% risk, we can see from the open low, it's right around here, $2.70 area. Now keep in mind, they're not always going to maintain the open lows on either the calls or the puts, but I do see this as something that shows within the market a few times a week. So off of the open, the main issue that traders have with taking an entry is not knowing if their trade is valuable or validated. And what I mean by that is, as it's pushing down on this options contract chart, when it's developing minute by minute, this looks like to the retail trader that it's going to break this support. And we always think of the worst case scenario, right? At a large knife, a big drop in the market, whatever it may be. But honestly, what this is doing is offering an opportunity for the bulls who are looking at the 315 calls for the potential to absorb with these market makers, these larger participants in the market, for a very low risk opportunity, right? It's great potential because we know where the risk may be. Now, this is just the 10% risk off of the open low. Someone could have traded a bit more conservatively and put a bid in at 2.8, 2.85, whatever it may be, but it's still within a 28 to 29 cent risk per contract, right? That 10%, which is a solid stop loss. And we can see here, if the trader is able to accept the risk, knowing going into any trade that this trade may turn into a loser, that is our goal in order to be able to have exposure into the market when planning an entry. The issue that traders run into when they do not have this confidence is chasing green candles, right? As price pushes away from this low risk opportunity, traders believe that this is the confirmation to enter the trade, right? We correlate this big green bar with buying, which would associate that other traders in the market are making money and the retail trader enacts upon that, right? So you end up getting a poor average. If we look at the average here at 322, which would be a 32 cent risk for 10%, your stop loss at the peak of this, you can see it says negative 9.95%, is actually where many traders are entering the trade for low risk. So if you've ever been in a trade where you've taken an entry that was a little late or a FOMO entry and you end up stopping out just for the trade to work in your favor, this is how you can prevent that. Solely by looking at either bidding in or only trading when price interacts with this low support level with a predefined risk. Now, let's say that you are able to grab your position size down here in this lower portion that offers very low risk. We can see the spread from 274 to 2.9. Where do you scale out? Now, for me, I always look left for potential targets to scale out. Of course, this has to align with the underlying chart, which is QQQ, but it won't hurt to look left and just to mark some key levels of resistance where sellers most recently entered into the trade. A good rule of thumb is as well that I always ask my students is to scale out into strength or scale out into resistance points. And what I mean by that is this. Say you grab an entry down here with the predefined 10% stop loss around $2.61. If you push towards the high here, $3.30, or you get a pivot high break, when price action breaks over another resistance level, creating a higher high, that should warrant you to, one, either scale out or move your stop loss up to the next potential pivot. So let's say a trader had taken a position here at $2.90 right at the open low price, and it pushed up to this high resistance. That's a 55-cent gain or a $55 per contract gain, or about 19%, which is a fantastic price target to scale out. But if a trader does have more of a position, let's say they're trading 10 or 20 contracts and they scale out an initial 25% of their position, then they should really look to hold their position by moving up their stop loss along the way and aiming for some of these larger targets where orders were met. Orders were filled here to sell. So as we can see here, this was a 19% gain. And as we move on, let's see how these targets would have hit, if they did hit, right? And one thing that I want you guys to take note of, a lot of traders, as the trade turns green, they move their stop loss up to break even. This is a great method, but it does cause a lot of traders to stop out or get wicked out as their entry may not be perfect. It may be good, but it may not be perfect. So as we see here, as it pulls back, you can see that this pivot here where it popped up, pulled back, a buyer stepped in right here. You want to see if this pivot is maintained, and you can put your stop loss at $3.01. And you can see as it pulled back again, if you've already locked in profit at 19% and you're still holding a half or a core position, this should not scare you, as you have offloaded some contracts, made some profit, and offloaded risk. Now, you can also move your stop loss up, like I said, and just to ease the emotions when you're in a winning trade, because I know a lot of traders have a hard time managing trades when they're green. So as it's pushed up, you can see these targets from the previous day on the options contract right here at $3.90 hit from the entry at $2.90, which was available all, the first hour after, or first 30 minutes after the open. This is $100 per contract move, a fantastic gain to someone who had this profit target area with these two resistance levels would have met had they remained patient and identified these and aimed to hold on to scale out at these targets. So you can see that that's $1.08 gain, so $108 per contract, or about 37%. Now, when it does this, I always ask students to move their stop loss up once again, just like we did here. So I'm going to turn this into a purple level to the trailing stop, which is, I use a mental, but some traders use a hard stop, which is great as well. So you can move your stop up to the next pivot. You can see it pops up, pulls back, and then hits $3.77. Now, you will lock in. This is your insurance. This will guarantee that you will lock in profit from $2.90 and not stop out below, I like to give a spread an area around $3.70. So you will guarantee yourself an $80 per contract gain. Okay, so as it pops up, could continue, but as it stops you out, it hits your level at $3.77. So you end up stopping out the remainder of your contracts here for a 30% gain, or 88 cents. 30% gain on remainder of contracts. This is how I trade every single day in the market, and this is how I ask a lot of traders who are struggling to identify their own systematic edge or even accept the risk when taking a trade. Now, I want to show you on the flip side, had you done the same thing, and how you can stop out of trades with predefined risk. So right here, 10% stop loss. Now, you don't always have to hold down to the 10% stop loss. I really ask a lot of traders to focus on what the underlying is doing. If you're seeing higher highs consecutively being made and you're trading puts or trading the bearish sentiment, there's no reason for you to stay within that trade. Many times you can stop out if you get a pivot break on the underlying. So I'll show you a few perspectives. Let's say someone tried the same strategy, trying to trade off of the open low, and it pushes through, cracks a pivot. This may wick out some traders because the trade could have continued, right? We see stop loss raids or liquidity sweeps all the time. But if this doesn't stop you out, if it hits your 10% predefined risk, you should follow your plan every single time. There's no reason in having a set of rules or quote unquote systematic edge if you don't follow it, right? What is the point of that? So that would be one perspective, right? You take your 10% stop and you do not complain about it, right? Fall in love with your stops and use them to your advantage. This is an area where traders really find themselves lackluster and not really refined, and they wonder why they sell their winning trades for very small amounts and they hold on to their losers. It should be the opposite. So if this session did help, I hope that you learned something. And if it did help, I hope that you guys can leave a comment and a like. And hopefully we can have some new videos out about every week. So thank you guys for your time, and I hope this helped.